This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The following chapter goes through and recaps two accounting standards that you will have seen previously in your F7 exam. And they are, first of all, inventory, which is covered by IAS 2, and then agriculture, which is covered by IAS 41. We know a lot about inventory already, don't we? We know how to value it with regards to valuing it at the lower of cost and net realizable value, and you perform that valuation on a line by line basis, don't we? So we'll go through and cover that within the next video. It's much more familiar. It was even touched upon at F3 level, wasn't it, when we introduced inventory as a year-end adjustment. So the focus, first of all, is going to be on your agriculture and IAS 41. And IAS 41 involves agricultural activity. How do we account for any agricultural activity that takes place within a business? So if you're out there in the real world, you're very likely to see inventory as a standard and valuing it at the lower of cost and NRV. But with regards to agricultural activity, you would only ever come across this accounting standard if you are the accountant within a business that performs agricultural activity. So whether that is going through there and breeding livestock to produce more livestock, or maybe to go through there and produce an agricultural produce such as milk or eggs, or whether that is going through there and growing trees in a forest or a plantation, growing sugar beet or wheat, and going through there and then harvesting that sugar beet, harvesting that wheat, harvesting the apples off the trees to go through there and then transfer that through to inventory, and then how you value at the lower of cost and NRV. So there is a link between the agricultural activity and what we then go through there and record as our inventory. So with regards to agriculture and IAS 41, there's two things that we need to think about. First of all, what you've got there is looking at the definition of what a biological asset is, and also what constitutes biological produce. And once we've done that, we then need to think about the measurements and then how we go through there and account for any change in that measurement before ultimately it's then transferred into inventory, whereby that agricultural produce is ultimately then sold to the end user. There's nothing complicated about it. Again, it's a big standard that focuses upon fair value, and we've seen plenty of fair value around previously, and then the numbers themselves aren't ridiculously complicated. So in terms of examinability with regards to P2, I would have thought it's more likely to be a question 2 or question 3 scenario, because the numbers tend to be a little bit too straightforward for a question 1, substituting it into your groups, and maybe the parent is involved in some form of agricultural activity. So it's more likely to be in question 2 or question 3. Okay, so let's go through and think about what we have with regards to a biological asset. A biological asset is any living plant or animal. So you're involved in agricultural activity. You have your cows, you have your sheep if you're involved there in livestock, or maybe you have your trees or your wheat or your sugar cane. Okay, it's a living plant or animal. Okay, and then what happens is that biological asset will then go through and grow, and as it grows it will give you agricultural produce. Now there's two things that come, if you like, with regards to agricultural produce. The agricultural produce could essentially be another biological asset. So if you have 2 sheep and those 2 sheep come together, then there may be a third sheep produced, and that third sheep is then the agricultural produce that is then produced. Okay. Alternatively, you could go through there and have your apple tree, and if you have your apple tree, as that apple tree grows, there will be apples upon it, and what you do is you then go through there and harvest those apples from that biological asset, and then those apples become the agricultural produce. Okay, they are the produce from the biological asset. So anything that comes from that biological asset, whether it's another living plant or animal, or if you like, just something that you're going to then use to carry on and sell at some point in the future, that is your agricultural produce. Okay. Key bits that we've got there are in terms of going through and looking at the measurement. Again, as we said, everything is based upon your fair value. Okay, and both biological assets and agricultural produce are measured at fair value. Both of them as well go through and deduct your estimated point of sale costs, so commissions that you may pay to the broker for the sale, or levies that may be charged by the local agricultural authority. They are deducted from the fair value. Do just note it does exclude any transportation costs. So the transportation costs wouldn't be included within a deduction, but you would actually take account of the fair value by incorporating those transportation costs. But that's just getting a little bit too complicated. The key bit is that your point of sale costs exclude any transportation costs. Okay, and when you're valuing the asset and when you're valuing the produce, you just need to go through there and give consideration to the points when we value the asset and we value the produce. With regards to the biological asset, we record its fair value initially and then at each reporting date, because don't forget that biological asset is going to grow. It could be several years before the apple tree is ripe enough to produce apples, or it could take a few years for the sheep or the lamb to grow large enough and big enough to be able to reproduce some agricultural produce. So we remeasure it at each reporting date. Okay, whereby with the agricultural produce, that is whereby there is the harvest, isn't there, from the biological asset. So when we remove the apple, or when the lamb pops out of the sheep. So what we have there is we look at the fair value there at the point of harvest. So once we take the apple off, what's the value of the apple? When we go through there and have a newborn lamb, we look at the value of that lamb. Okay, again, less estimated point of sales cost. Again, the same commissions, and is it their levies? Key bit is that we've got the fair value of the asset and the fair value of the produce. That will go through there and give us a gain or loss. So that gain or loss there is taken immediately to profit or loss. No measurement through other comprehensive income. It is just any gain or loss immediately to profit or loss. That's what you show within the financial statements. You could, if you so wish, and it's entirely up to you, you could make separate disclosure within the notes to the accounts about how that gain or loss has arisen due to a physical change in the biological asset and a price change within the biological asset. Because if we're valuing that biological asset at the reporting date and doing that at each reporting date, then each year that biological asset will be 1 year older, won't it? So it will have grown physically by another year, but there will also then be a price change in the value of that asset as well. Okay, so you could disclose that separately. It's voluntary, you don't have to, but you could disclose it separately within the notes of the accounts if it is useful to the users to show the price change and the physical change. Okay, in terms of our example that we have over the page, nice and straightforward. It says explain the accounting treatment of the above in the financial statement. So a little bit of a narrative style question, gearing it more there to say question 2 or question 3. So it says there, Ted started running a farm that is involved in agricultural activity. So as soon as we have agricultural activity, we are there, aren't we, into the realms of IAS 41, whereby it buys dairy producing cows. So the cows are the biological asset, aren't they? If they are dairy producing cows, they are not cows that are held for slaughter. It's dairy producing cows, so the agricultural produce will be the milk. Okay, so that milk will be measured at fair value at the point of harvest, and it will then be taken into inventory, whereby the cost of that inventory will be that fair value less the point of sales cost, isn't it? Okay. At the start of the financial year, Ted purchased 1,000 dairy cows with an average age of 2 years for $1.5 million. Wow, I have no idea in the real world how expensive cows are, but that sounds quite a lot. But if you've got there 1.5 million and you bought 1,000 of them, then that means is it $1,500 at the start of the year. So you can see there your 2-year-old cow, the fair value less point of sales cost at the start of the year, and there it is at 1,500. So initially we recognize those dairy cows as a biological asset at 1.5 million. Key bit that you've got there is at the end of the year, we need to look at the fair value of those cows. Now, the key bit there is that they were 2 years old at the start of the year. They're now 3 years old. So we have there, don't we, the fair value at the end of the year is there at 1650.10. So at the end of the year, what you're going to go through and have there in terms of your financial statements, on the SFP, you have an asset, 1650.1 multiplied by 100,000. Careful, do the right numbers on my calculator, that would help. Does that give me, is it 1,650,100? So that will be there, your biological assets. And then what you have as well on your statement of profit or loss, I think you have a gain, don't we? And that gain that you have is the movement. So is that 1650.10 less the 1,500 multiplied by 1,000. And that goes through there and gives me a gain, is it, of 150,100. Okay, that's it. Okay, you could go through if you wanted and add things further using the information in the question to say that, look, that gain of 150,000, part of it is due to a physical change, the fact that the cows were 2 and they are now 3. And then you could also go through there and think as well of the change in the price of the cow. Okay, but I'm not too fussed about that. I don't want to overcomplicate it. Like everything, we want to try and keep it as simple as is possible. If you can understand the basics and apply the basics within any exam question, then you're not going to go too far wrong.